All right, well, it looks like we're at noon here, so hello and welcome. We'll get today's virtual forum underway. I'm Jeremy Parkinson, and I'm City Club board member, immediate past president, and I will be moderating today's discussion. This program is being delivered online, so welcome attendees. Please note that you will not have video or audio from your computers. We will only be hearing from our panelists. I want to welcome our radio listeners who will be joining us at a later date via Boise State Public Radio on KBSX 91.5 and its affiliates throughout southern Idaho and northern Nevada. This program is being recorded for our radio broadcast and will be available on YouTube as well next week. Today's forum is available for our audience in large part because of our City Club partners and sponsors. I would like to take some time to thank a few of those organizations that help us achieve our mission to ensure compelling conversations, engaged citizens, and a dynamic community. Our premier sponsor is Northwest Nazarene University and the NNU College of Business. Our annual sponsor is St. Luke's Health System. We also receive support from our Forum Series sponsors, AARP Idaho, Bank of Idaho, Climatech Corporation, Echelon Group, Micron, Pacific Source Health Plans, and Small Mine Development. City Club of Boise receives grant funding from the Idaho Humanities Council. I'd also like to thank our media partners, which include Boise State Public Radio, 670 KBOI, Idaho Statesman, and Idaho Public Television. And our university partners, University of Idaho, Boise State University, and NNU. Many thanks for those who support City Club with their memberships or through making donations during registration. It's a weird time, as everybody knows, with COVID and without being able to have in-person conversations. We do need your help during this time of disruption as we try to make sure we remain vibrant and bring the important conversations, even if it's virtually. You can help by texting the word Boise to 243-725 and make a donation in any amount, whether it's $5 or $50. Any amount helps and helps us make sure we can meet our budget needs in these strange times. So appreciate all the support. I know before the event started, there was scrolling through those sponsors, and we really couldn't keep it going without all that support. So thank everybody for all you do for City Club. I would just like to briefly mention that if you want to find out upcoming events, we've got more virtual conversations coming up, some good topics. One in particular I wanted to bring up, you can go to our website, cityclubofboise.org, to find all those events. But one in particular is our Marilyn Schuler Human Rights Forum. This is our third year doing this in honor of Marilyn Schuler. We had a great event planned in March, and we were ready to bring in a really great speaker, Laurel Thatcher Ulrich, and have a great lively discussion. And of course that happened right before COVID and everything shut down. And so we had to redo plans, and she wasn't able to travel. And through the work of the board and through the work of our staff, they've really worked hard to make sure we can make this happen. It's going to be a live virtual event on September 23rd at 10 a.m. We're excited to have Laurel and hear from her, and encourage you to go on and register for that event. Following our speaker's opening remarks, there will be an opportunity for him to respond to your questions. You can use the Q&A function of Zoom and type in your question there, or you can email it to Morgan at cityclubofboise.org. Once again, that's Morgan at cityclubofboise.org. She will get those questions to me, and I will accumulate them and maybe put some together and try to get through as many of those as we can as we get through this hour presentation. But without further ado, let me introduce our speaker. We're very pleased to have Bob Maynard join us today. Bob is the Chief Investment Officer for the $19 billion Public Employee Retirement System of Idaho, better known as PERSI. He is responsible for all investments activities of the organization. He has served in that position since 1992. Been through a few of the different pandemics, or maybe not pandemics, but crises we've been through in that time. Previously, he served as the Deputy Executive Director of the Alaska Permanent Fund Corporation. and is Assistant Attorney General for the state of Alaska. In addition to his duties for the Idaho retirement system, Mr. Maynard participates or has participated as an advisor, board member, or chair of a number of investment-related and charitable organizations, and has lectured frequently on investment topics at numerous conferences and institutions. So Bob, I'm gonna let you take it off from here. Let us know what we got going on. There's a lot out there, I know, in the world of investing. So Bob, take it away.
Be glad to, and it's a pleasure to be here. Thanks for having me. In fact, Marilyn Schuler hired me when I came here in 1992. So
wow.
I heartily endorse the upcoming. She was a marvelous person. She had been a board member for many years and served on the PERSI board. In fact, she got me involved in a number of the organizations I'm involved with, including City Club. I was on the City Club board for many years back in the day. So I highly recommend that you get a monster attendance or listening audience for anything about Marilyn Schuler. She was a life extremely, extremely well lived. No, I'd love to talk about today. I mean, this is, if you'd have told me a year ago, or even 6 months ago, that we would have the worst economic conditions since the Great Depression, in some respects, even worse, that a pandemic had shut down the world, that there was, it'll be going on for another year, I would never, ever have predicted what would have happened with the markets. As of, it says we're a $19 billion fund. As we're speaking, we're hitting new highs, all-time highs in the fund. We're rolling past 20 billion as I speak, if today's update holds. The capital markets are clearly not following what the economic conditions or the current economic conditions are. And that has a lot to do with the extraordinary events that started in February, March, and April. I think everybody who saw the pandemic coming in my industry was expecting that it would be similar to SARS and to some other swine flu, other types of fears of the past, that it would be contained, that it wouldn't. But it turned out that this is kind of the unfortunate perfect storm of a disease, one that isn't as deadly and as easy to stop and control and contain as the ones in the past. And I think that the really tough part was the realization in early March, late February, early March, that this was not going to be something that was going to be over soon. And in early March, you had that feeling of there was a bottomless pit we're starting to fall into. For the first time in my career, and I've been doing this for now 4 different decades, going into a 5th, I've never seen the Treasury market freeze like it did in early March. And what was extremely remarkable is for all the yelling and screaming and the splits we have politically nationwide, how the Congress, the Republicans, Democrats, the administration, and the Fed all came together on March 22nd, 23rd, and set a huge amount of stimulus in, lowered interest rates, backed up. I mean, whereas in the previous crises that we were in, there was a more graduated response. It's kind of like during the 2007-2008, I described it back then, was that it's kind of like the way that everybody responded was that you have a fire on your kitchen table, the toaster starts to spark. You unplug it, it sparks and lights the tablecloth on fire. You throw some water on, it spreads to the table itself. You start trying to find the fire extinguisher, if you can remember where you put the fire extinguisher, and you start spraying. And so the Fed started spraying liquidity, and the Congress, if you remember back then, didn't act on the first TARP, on the first attempt. And then everything kind of rolled out of hand until they finally brought in the fire hose and soaked everything. Well, here on the first day, they soaked everything. Congress acted, the Fed acted, and that really turned things around. And since then, the market's come back, and we can talk about the circumstances as to why that is. But for a while there, for about a 1 or 2 week period, you got that feeling in the pit of your stomach that you have only gotten a couple of times before, where it looked like there was kind of a bottomless pit we were rolling into. And we rolled right out of it. And like I said before, as we speak, we're hitting new highs.
Bob, I know a lot of investors are probably concerned a little bit that it has bounced back up so quickly, and concerned that are we going to have another sell-off? Is the fundamentals there to support that going forward, or are we setting ourselves up for another sell-off here?
Possibly, but I don't. There is a number of reasons to support the current market valuation. Four, probably in particular. First of all, and this is always true when you talk about the markets, and particularly the US stock market, but the capital markets worldwide. The capital markets and the stock market does not follow the economy. It is much different than the economy. A couple of main reasons right now. Infotech and telecom utilities are 32% of the S&P 500 in revenues. It's only about 7% of the economy. Retail is about 26% of the economy. It's only about 15% of the stock market. And the stock market is primarily dominated by large companies who have done adequately well in all of this. Whereas a lot, the mid and small cap are only about 15% of the whole stock market. And even then, a lot of the private businesses, the smaller private businesses that are really hurting in this economy, are not represented in the stock market. And so a number of those big companies are doing well. That's number one. Number two, the stock market does not reflect current values. Or values in and of themselves. They reflect relative values compared to where else you can put your money. And right now, there's no alternative to where you put your money. When you have treasuries, 10-year treasuries only paying you 50 basis points, that means that stocks are a good value compared to where else you can put your money. There used to be, for many, many years, the earnings yield on a stock, which is the reverse of the PE ratio. So right now, the trailing PE ratio is 25, which looks high and is high historically. That's a 4% earnings yield, 25, 1/25 of 100. It used to be that the 10-year treasury yield was above the earnings yield, and the earnings yield used to go up and down with the treasury. Well, right now, the treasury yield at 50 basis points, 0.5%, is 3.5% below the earnings yield, which supports stocks being valued relatively highly. Why put your money in 10-year treasuries and only get 0.5%, where if you own a company, the earnings on that company are going to get you 4%. The third is that this is a little bit more difficult, but the stock market discounts current earnings back to the present day. And so as a result, you're looking at what you expect to earn 1, 2, 3, 4, 5, 10, 15, say out to 20 years. And you're paying today for expecting getting those earnings for like 20 years. When you do the valuation, particularly when you say, what's the present value of those earnings, particularly when you're discounting back at today's bond yields, it turns out that the value you're paying for a stock, 95% of that value is dependent on earnings starting 2 years out. In other words, you could destroy all the earnings for 1 year, and the stock market, the stock itself, would only go down 3% because you're not depending that much on next year's earnings. Well, everybody expects that after this virus will end. Unlike past crises, you can see an end. Now, I think most people right now in my industry are saying this won't end until next summer. but you do see an end. And so if you say no earnings for that period of time, it only goes down 3 or 4%. But it turns out a lot of these companies, like the FANG stocks, like the telecom stocks, like stocks like Teladoc, things of that nature, they're actually making pretty good money. And so as a result, you're getting money even when you're not relying on it that much. So for those three reasons in particular, you can mathematically and logically support current values and even higher values than we're getting right now. Now, having said all that, do I emotionally believe it? No, it looks crazy. How can this be true? But this is a real lesson on how the stock market looks at things that aren't intuitively, emotionally resonant to us.
You mentioned FANG, and you mentioned the technology, and you know, a lot of the returns have been driven by that growth sector, right? And the last, I don't know how many years, but certainly the last few years.
Right.
You know, value stocks have been somewhat underperforming, and maybe small
It's
cap.
been tough.
Do you see that kind of continuing with a narrow market, or do you see it broadening at some point? And what's your thoughts on that?
Value stocks are in the same position. If the best way, first of all, if you're a value investor, if you're a value stock manager, you are looking primarily at things that are tangibly in front of you, cash balances, businesses that are giving you current values, things that have tangible assets you can grab on and sell. And you don't depend on the kindness of strangers, of true deep value managers. You're looking, but when cash is trash, and you can get loans at practically free, having those sorts of assets aren't valued as highly. And so as a result, that the stuff that depends on current income, current tangibility aren't valued as highly. And that's been the case for some time, but particularly given the low interest rate environment we're in and the low inflation environment. I don't expect that. They might have hit a bottom, and you're seeing some signs that the spread between value and growth may have hit a bottom, and so it may keep up. But that big run we tend to see every once in a while in value stocks. We have value managers. We're keeping them. We're not going to get rid of them. But yeah. I'm telling my value managers, look, I'm not expecting you to make one of your tremendous runs that comes all at once. A value manager has to stick it out in case it comes back. But it's tough to see in this environment that coming back any month soon. The next couple of months are going to be extremely interesting. To see whether or not any stimulus is going to be passed and how the progress grows on vaccine. But I don't expect anything to dramatically turn things around for our good old value managers. Hope I'm wrong at times, but
a questioner or a listener brings up, you talked about the markets are, we're mainly talking about large companies here, in U.S. I might point out, most primarily U.S. large. And some of those smaller companies may suffer more. Ultimately, does that end up affecting the larger companies if the smaller companies don't do well? What's your thoughts on that?
There's a debate going on in my industry about that. Some say it will affect the larger companies at times because of supply chains, et cetera. On the other hand, there's been a debate even before this started about the prevalence, not only in the US, but worldwide, of what are called zombie companies. That because the low interest rates were keeping a number of companies alive that weren't really even making revenue, weren't even covering costs. And they were able to do it because there's a plentiful, cheap supply of capital, which has been extended during this period of time. A number of companies that we invest in, including some of our private equity funds, are actually thinking that if this crisis continues on, it will take out a number of those zombie companies and allow for people to get better price control. For the first time in 10 or 15 years, I'm starting to hear a number of people starting to get worried about inflation, that companies may regain some pricing control once all this is over. And that it could be a two-edged sword. That a lot of the smaller companies that are barely holding on may go under over the next year, and that will open up the field for those companies that are better positioned, have better assets, are stronger on their own. And in fact, that's one of the arguments you will hear value managers say about why they think they will come back in the next year. I don't necessarily believe them, but I'll give them their point on possibilities.
So you brought up stimulus. Obviously, there was a huge amount of stimulus done in the initial round. They seem to be kind of going back and forth on more stimulus. I guess a couple of questions I had was, one, do we need more stimulus? There's some sectors that probably still need that, individuals maybe. And then two, kind of getting that inflation theme. With this much being pumped into it, is that even on anybody's radar as a risk of what's going to happen because of all the stimulus?
Well, the answer to both questions are yes. Putting a quality on it, though, is a bit more difficult.
Yeah.
I think everybody agrees some more stimulus is needed. The question is how much? Is it at that 2 trillion or is it that $500 billion number? And that is anybody's guess. Personally, I wouldn't mind the more stimulus. I'd rather overreact than underreact and worry about the cleaning up afterwards. But that's the real inflation problem. I mean, the inflation problem is, what if this really works well? What if it comes bouncing back? What if the economy does come roaring back? Now, in theory, the Fed has soaked everything with liquidity, and in theory, they can pull that back. They can sell the bonds they have. They can raise interest rates. But it's kind of like the problem is like you have your house on fire and you soaked everything and there's all this water. Yeah, you can mop up the water, but the sofas and everything there are still soggy and wet. All these companies have a lot of firepower still left. One of the most amazing numbers, and one number I'm watching and going in the future, is the savings rate during the stimulus jumped up to 13%. You may remember back in the aughts, everybody was so concerned because the savings rate was down at 4%. I mean, a lot of the money that's been put out there has gone into savings, and that's a potential source if the economy comes back, if a vaccine gets out there earlier than people believe, or there's some other thing, that you can see a lot of excess wealth out there, not only in the US, but worldwide, come roaring back just from the internal resources that isn't as well under control by the central banks. So the answer to both questions is yes. I wouldn't mind seeing more stimulus, but yes, there is a fear that inflation may come back, and we're not talking 2 to 3%. We're talking inflation at a higher rate.
Yeah, we haven't dealt with that kind of inflation for a long time, right? I mean,
it's I don't think we have the muscle. I think we've lost the muscles for that. It's actually many people. There was a period of time in the 70s that lived through called stagflation.
Yeah.
Where and that's a real fear. I think that the levels of debt, not only of the country but of individuals, would have a tough time handling stagflation, and I see that as the real big threat. But that's still a couple of years off. There's still a a ways to go to get there. Put it this way, if it comes back, we're going to have a real happy period of time for a few months at least.
For a few months.
At that point, I may retire, you know.
You may retire.
Yeah, that's it. Timing, secret of a good job.
Good timing. So, we all know we're in an election year, and it's very contentious with everything that's going on in the country. And how do the markets price in or react to an election year, especially for a presidential election year? And does the market care one way or the other? Is there historical data on that, or?
I'm historically, I am of the view that there may be some temporary reaction, but you'll see it pretty much discounted by the time the election occurs. I mean, that's why September, October, I think is going to be very interesting, not only on the vaccine front, not only on whether or not the school reopenings occur, but also whether the stimulus is there and if there's going to be a reaction on the election. Generally, it's been my experience that while people yell and scream about big economic changes with new parties coming in, the actual impact is transitory. That a lot of the big issues are not permanently affected, but there's obviously people who believe differently. I'm just not one of them. I prefer to worry about other things or not worry about the other things.
Yeah. Just like to remind our radio listeners, you are listening to a City Club of Boise virtual conversation with PERSI Chief Investment Officer Bob Maynard. We talk a lot about U.S., I guess. What are the international markets doing right now? Are they reacting similar or is it different?
They were reacting differently for a long period of time. One thing that people forget, I think everybody knows in investing that the main principle is diversification. Don't put all your eggs in one basket, then you get better risk return on this. But one thing that people forget about diversification, and that means into other asset classes, but that also means worldwide, is that diversification means always saying you're sorry somewhere. See, something's always not working. And for the past 5 years, what hasn't worked is overseas. If you have been outside the S&P 500, whether it be small cap and S&P 500 growth for that matter, whether it be small cap, value, overseas, developed markets, emerging markets, you have gotten crushed by just the performance of the S&P 500. You're starting to see that turn around. Europe was having extremely difficult times. Their capital markets are also now starting to catch up. But the fact of the matter is they have a long way to go to catch up. The U.S. stock market has more than doubled what overseas markets have done. And so there is some indication, and a lot of it's because the sectors overseas tend to be more tangible industry sectors. Asia and Japan have had difficult times. China was going up and down and was impacted by the trade wars, and will be impacted in the future, although it's coming back strong right now. Latin America, a key emerging market, because of the drop in commodity prices, which hits Idaho quite a bit as well. That has not helped. So you're starting to see, everybody says there's better values overseas, and that is true. But the reason there are better values is because people were saying out there, the growth prospects were just great, and they weren't. And the question now is you're starting to get some faint indication that value overseas, the things that people have been diversifying into and have been sorry about for the last few years, not just during the pandemic, may start to see glimmers of light and hope.
Maybe an area that's a little bit outside of your expertise, but you guys probably have some holdings in this area too, as far as through REITs and things like that. Is real estate. I'm hearing a lot of large law firms, things like that, are finding, hey, we can work remotely. Maybe we don't need all this office space that's in downtown San Francisco or New York. And have you noticed any changes in how that might look going forward with people working remotely?
Well, there's a couple of things on that. I'll start with Idaho first, and then kind of go to the broader indications. We do run, I think, the largest commercial mortgage program in the state. We have about $1 billion of directly owned first lien commercial mortgages that we service, and et cetera. It's done marvelously. The Idaho real estate market, a lot of what we feared did not occur. It may have been because of the stimulus. It may have been, but the people that have loans with us, we've only had to work out issues with a few of them. There's no defaults. It's been a relatively healthy response, at least at the commercial mortgage level. The underlying businesses just oftentimes have problems, but in terms of the people doing the mortgages, it's been quite healthy. That is also true of, we have a real estate program nationwide as well, owning individual buildings. And I think that I've been spending more time with our real estate than almost any other part of the capital markets, because it appears to me, at least, that when you're talking about what's the long-term impact going to be of this pandemic in terms of people's lifestyles, of central business offices, of hotels, of travel, you're going to start seeing it first in terms of how real estate responds, and how the real estate market comes back. Central office, for example, a lot of people are very curious about that. On the one hand, yeah, people may not need working remotely for a number of professions has turned out to be almost more productive. You don't have to drive in for an hour and a half and do all the things you have to do. And that the ability of people to interact by Zoom or by WebEx or by Teams or by whatever has been much smoother than people expected. On the other hand, people do like the social aspect of working together. It's a more dynamic situation. The unusual nature of this over the last 5 or 6 months may fade as we move into next summer. I know my real estate guys, they're dying to get back on a plane and kick some buildings, do things. And this way of working is tough. One thing that's interesting on the office, just as an aside, one of the major trends since the 90s was that office space per worker was shrinking. You were getting more of the WeWork. You were getting more of the more packed in office space. It may turn out that we're going to go backwards, that people will need more office space and more office space per person. No more everybody in a bullpen in the center, but everybody has outside offices that you can close the door on because of you could see that. But for right now, the things that are clearly going to be impacted, the traditional wisdom is first hotels and travel, particularly hotels that depend on conventions. Secondly, central business district office. Third, retail, particularly malls, indoor retail, but just retail itself, maybe. Those are the big three that people are very curious to see whether or not this can be a longer term impact, whether things like Instacart and Amazon Prime and the way things are being delivered, whether or not that sticks, or whether or not the shopping experience itself was a reason to get out of the house. And instead of going to parks, people went shopping. So that's going to be, that real estate, I think, is going to be the leading indicator of what trends stick, what trends were merely accelerations of things that were happening already and are going to go slow down again. and what aren't going to be affected at all. I find it fascinating.
Definitely.
I've been telling my peers, I mean, for 10 years, my business was getting kind of boring. Every year was kind of like the next. Every year, marginally up, but the issues were about the same. Where's inflation? Can't see it. What's the jobless rate? Low. And I've been telling them, if you're in my position, if you're not fully engaged and just involved, get another job. I mean, this is as much interesting as it gets. And it'll be this interesting for the next year. Like I said before, I think everybody doesn't expect things to start to go back to normal until next summer. And it's going to be the year after that we're really going to see the impact of what we're starting to see now in terms of trends on living conditions.
Yeah, so you touched on it a little bit, but a listener is asking about tourism and what kind of an economic effect that has. Obviously, I think some localized tourism has done okay probably, but traveling overseas or taking a plane and going somewhere probably has been affected more. What kind of economic effect does that have overall? Is it significant, or probably locally it is?
It is significant. It's going to be significant, and until there is a vaccine, it will have a tremendous impact, particularly on international travel. The real estate guys I talk to, not only mine but others, they're starting to nibble at some hotels that are in locations people drive to that don't depend on conventions. That may come back first, but travel clearly is going to be difficult until you get the vaccine situation under control. And I understand a lot of people are not going to be vaccinated, but those that are going to be on the road are going to want to be vaccinated simply because you just can't be in that closer proximity. So it's going to be interesting to watch.
And another thing that's somewhat related, I guess, is is sports. Here locally, Boise State football not going to happen this year. That's a big number of an economic impact, and that's happening many places all over the country. It affects a lot of different levels, right? I mean, how big of an impact is like sports? I mean, it seems like it's a big part of our lives, and leagues are trying to find ways to do it, but fans aren't going, and there's no travel. I mean, it seems like that'd be especially certain areas, might be a very big impact.
That is true. That is true. And a number of universities depend on, like Boise State. Yes. But I mean, that's why I say the next couple of months in terms of whether the schools can open and stay open, or find the means to do the testing and the isolation and what needs to be done. That, I think, is that along with whether or not a stimulus is passed, is going to be something that's going to be watched quite closely. And that is also going to determine whether or not they can work out procedures for schools. Maybe they can work out procedures for appropriate spacing. Instead of a packed stadium, you have a more loosely defined stadium. Korea started up sports again once they got, so it's possible. And remember, sports lasted through wars where they had similar situations.
Right.
And again, that's the one thing about this crisis that's different than almost every other crisis. It's going to end. And unlike a war, buildings aren't being destroyed. You're not taking out the young population. It's only the older populations that's being impacted. It will end someday, and it will end within, I mean, months seems like lifetimes, and next summer seems like it's extremely far away, but it'll end. And so as a result, and the infrastructure will be there, and the talent will still be there. So I think that it will be interesting to see whether or not the teams and the sporting facilities and the schools have the resources to make it through to the other side. But unlike the tech wreck and unlike the great financial crisis, when we didn't know whether or not we were heading into a Great Depression that's going to last 10 years, this time you are kind of able to see a reasonable end. Future's still uncertain, but as they say, this too shall pass, and it'll pass more quickly than other crises.
So
I hope.
Yeah, I know, right? It feels like it forever, but
Yeah.
You're right. When you look back in the broad scheme of the thing, it will probably be a relatively short period of time compared to like a World War II or something like that, right? I mean, it's maybe it's 13 months, 18 months. Yeah.
Or even the great financial crisis of 2007 to 2009.
Right.
I mean, like you know, this isn't my first rodeo on a crisis.
Yeah.
And when you look back after it's over, you're always amazed at the recovery power, even with those that take a fair amount of time, like the 70s, the stagflation, and like the huge inflation of the 80s when it was getting under control. This is bad. And the temporary impact was quick, and the unemployment was quick. But it feels worse in many respects. But looking back, I don't see this as being worse. I mean, when you were talking about, am I afraid of a monster market crash? Unless there's something unexpected that occurs in the next year, that we don't find vaccines, that something else happens. I think the attitude of the markets is that this will be over and some normalcy will return. But getting there.
When you're in the midst of the storm, it feels like it'll never end, right?
Well, I told us now. I used when I was young and had potential. Before I got in this business, I spent a couple of summers. I was a aquatics director at a place called the Newport Harbor Yacht Club, and it was about 3 blocks in Southern California. It's about 3 blocks from a famous body surfing place called the Wedge. And I go there every afternoon after I was done and body surf. And it's a shore break and it's big. I wasn't that good, by the way. I mean, I wasn't all that. But there's a period where you take off on one of those waves and they're big. They can be big 10, 15-foot waves crashing down, where you all of a sudden realize, oh my God, I'm in the wrong place. I don't know what's happened. And there's that first elevator drop going over the falls where you don't know where you're going to land. You know you're in the wrong position. You know it's that sickening sensation to your stomach. And it's the exact sensation I was talking about having in March. I don't have that feeling anymore. We've kind of made the landing. Now it's trying to get out of the water now is the problem. So yeah, it's bad. It could get worse. If the schools get reclosed, they don't pass a stimulus, all that, you could see a retreat from where we are now. But I don't think we're going to head back into that first elevator, dropping down the elevator shaft feeling that we had in early March. At least if we do, I'm finding a way to become a bear and hibernate until this is all over, because I don't want to go through that again.
Yeah. So just another quick reminder for our radio listeners, you're listening to a City Club of Boise virtual conversation with PERSI Chief Investment Officer Bob Maynard. Bob, so I'm a retiree. Let's say I'm a retiree right now, living off of my portfolio, and you know, interest rates near zero. How do I find some yield, or what do I do for that? Is there dividend paying stocks that are a good idea, or do I just have to ride this out? And
we are right on top of our asset allocation. But my advice to everyone has always been ride it out. You got to realize that bonds were never there, at least in our portfolio, to be real income producers. Bonds have always been our Armageddon hedge. And they were our Armageddon hedge in the great financial crisis. They were an Armageddon hedge now. They were the pool that we could dip into to replenish our stocks when they went down. So as a result, and now stocks have come back and we replenished where we were low back in March. That's the old principle of rebalancing when times are bad. Going forward, yes, it is true that bonds will be dead money. And it looks like, but we've been expecting bonds to be dead money for the last decade. Everybody was expecting coming out of the great financial crisis for bonds to go back to 3, 4, and 5% and you to get zero. It just turned out to be the other way around, that bonds that were dropping and have been actually good place to have wealth against everybody's expectations. But you can see coming back, for example, if the world does start to come back to normal, you can see stocks from here going up 8, 9, 10% a year. You could see it. Not that you can't ever predict these things, but you could see them doing that. If you have a GDP that comes back at 4 or so percent, 4 to 5% for a few years, you're getting a dividend now on stocks of 2%. And plus stocks are being bought back, which is even more yield. There are a number of people that are fairly optimistic, and you may finally get a contribution from a number of markets overseas that have been basically dead money as well for the last number of years. So the same old principle of diversification. For the last 20 years, 30 years, people have said the good times in the markets are over. In fact, when I came here in 1992, people were saying, well, the 80s are over. The old way of investing is dead. You should do something different. Well, it turns out $1 given to PERSI back in 92, when I got there, is worth over $10 now. It's been a tremendous number of years. And so I think I've kind of learned over the years, don't make major moves until you really, really have to. That basically being patient, simple, transparent, focused on a good old-fashioned conventional investing at whatever your equity fixed income is there. Stick with it. It's worked over the last 40 years. I think it'll work over the next 30. And one of the things I'm going to be most interested in is a number of my colleagues, in anticipation of projected bad times, are starting to do odd things. Increasing leverage, putting a heck of a lot more into private equity, trying new tactical asset allocation strategies. But every time people have done that in the past, it's turned out to be worse. It's kind of like running around in an earthquake. No, stay put in a sound structure. I mean, that's been our philosophy. It's worked out for the last 30. And I want to see the whites of the eyes of something truly change before we're going to be changing our investment style. We've been basically the same fund with a lot of the same managers, but the same basic structure since the 1990s. And we've continued to be well-funded. Like I said before, we just stuck with it, and now we're back to all-time highs as we speak. So
obviously you've stuck to that philosophy and done well over the years. You know, I know in other meetings in the past when we've talked that maybe some other public retirement systems haven't performed as well. How do you have a feel on how other states are doing, or
the states that are having problems, we're in this crisis. I mean, over the long term, we're top quartile, but in this crisis, we're kind of in the middle of the pack. Everybody, if they stick to their knitting, and most of the people in my business do that, are fine. We'll probably end up, we're above median, but we'll probably end up well, but we're not going to lead the pack, by the way. We never do. Yeah. That's not what we're trying to do. The systems that are in trouble and are digging themselves deeper, really it has little to do with the investment side. Whatever it has to do with whether or not the political system has put the contributions in or funded it correctly. And whatever side of the political spectrum you're on in Idaho, Our legislature, our governors have been heroes, absolute heroes. They have never underfunded the system. They have never tried to use the system for some other political purpose. They have never interfered for some political objective. They have been absolute heroes. And we expect that to continue in the future. There is, no matter what side of leanings they have. So that's why we're in good shape. That's why you see Kentucky in bad shape. That's why you see Illinois, New Jersey. It hasn't been that their investment returns have been a disaster. It's been because the money has been diverted for AstroTurf ballparks or whatever else those particular political systems did with the money. And the ones that are in trouble are on both sides of the spectrum. It's for whatever political purposes, but ours have never done that, and there's no indication that our system's going to change its stripes.
A listener asks, what would be a good investment now, stocks or real estate? I think maybe you'll say both, but what's your...
It depends on the stock and it depends on the real estate.
Yeah.
I definitely wouldn't buy a high-end hotel that depends on conventions and lots of plane flights for at least another year or two. But there are still reasonably attractive values out there. Like I said before, emotionally, I don't believe it. But if you look at all the things that have historically driven the capital markets, you can see support for current values. They may be high. I am not in the camp of a number that say this is the most overvalued and ridiculous market they've ever seen. There's other opinions on that. And when I look at those numbers, I'm not as pessimistic. And I don't have individual stocks, so we tend to index. The managers we have tend to have very clear styles, and some do extremely well when their style's in favor, and some are value managers, and you know how value managers. So I'm pretty comfortable with our diversified. We have the Idaho mortgage program. We have regular bonds. We have emerging market stocks, U.S. stocks. We have some private equity. That generally diversified, well spread out view without trying to get too fancy. We don't tactically asset allocate. The worst time to make a decision is in the middle of a crisis. And when you tactically asset allocate, you don't have to make one decision right. You don't have to make two decisions right. You need to make three decisions right. When to get out, when to get back in, and where to put the money in the meantime. And if you goof up any of those threes, you'll be much worse off. And so that's why if you get one time in a crisis, actually on any time, what I do in a crisis, I get a bright idea, I go to a dark room, I lie down, and I wait for the feeling to pass, because that has tended to be the best call in times like these.
We're running out of time here, but we kind of talked about, if retiree, maybe what they should be looking at. So I'm a young person just looking to start putting into my retirement account or whatever. What kind of advice would you give to someone like that that's just getting into investing?
Just getting into investing, heavier stocks and bonds, keep putting the money in, and wait. Like I said before, every dollar you put in our fund back in 1992 is worth 10 now. It's tough to time markets and whatever. Usually, the standard rule of thumb is if you want to retire at around 65, you should be putting aside between Social Security and another retirement system like PERSI, or if you have your own 401k, you should be putting aside 30% of your money in order to, and let that compound at about 4% above inflation. And that's usually why you have a 70-30 equity fixed income split, because historically people say we're lemmings because we all kind of do a 70%, 60 to 70% equities, 30 to 40% bonds. But the reason for that is what gets you around 4% above inflation over long periods of time. And if you put aside 20% of your 15 to 20% of your salary and put the rest into Social Security, by the time you hit 65, because you're going to expect to live 30 years beyond retirement, or at least you that's kind of what you plan for. If you win and live longer, you run out of money, but if you lose, it's kind of a half a dozen of one or the other. But that 60-40, 70-30, stocks, bonds, don't do anything stupid, put aside 15 to 20% of your money, hope Social Security will be there. That usually picks up about 40% of the wage, and you get the other 60% by the money you set aside. You'll be fine.
Great. So a quick question. We talked a little bit about like other retirement plans, I guess. Let's had a question about the post office, because they, part of their issues is the requirement they fund pensions in advance. Do you have any comments on that? What maybe what that problem might be?
Well, it's a number of retirement systems worldwide. These are were pay as you go.
Right.
No money was set aside, and now they started to put aside money. So the decision as to whether pre-fund it, like PERSI does, or pay as you go, or push it off somewhere else, it's a tough one. I don't know the numbers on the post office that well, but I will say this: when you're and this is why Canada, it looks like it's in such a good position. When your population is mostly active members, it's easier to keep the system funded because you have more contributions coming in. As you get older and you pay out more than you take in contributions, then that's where you're doing your investing previously. PERSI started in 65, but we're paying out, I think, close to $1 billion a year more in Idaho than we're taking in contributions from the government. And what's happened is because we invested outside, all our investments outside in other states and other countries are like a giant money pump, pumping money into the state. And so we've reached that point in the age of being a retirement. And I just don't know with the post office whether or not they had what their funding system was. It really depends on your population and where.
Yeah. Well, appreciate your time so much, Bob, today.
Always fun.
Great conversations. Just a minute or two left. Any closing remarks before we leave?
The only closing remark I have is everyone tune in and listen to the Marilyn Schuler. Like I said before, I've met many remarkable people in this state. I can't think of anyone I valued more highly than Marilyn. So it's a wonderful thing you're doing for that program. Other than that, this too shall pass, and things will be normal 2 years from now. I look forward to those days returning.
Thanks, Bob, and thank you, audience, for your questions and engagement today. Appreciate your time, and we'll see you at the next virtual conversation for City Club. Thank you, and we'll see you later, Bob. Thank you.
Thank you.